You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Hey, thank you for tuning in today. You're listening to the Generational Wealth Through Commercial Real Estate show. Got a really great guest lined up today. His name is Rohun Jauhar. He is the co-founder and managing partner of JT Capital, managing a real estate portfolio of $500 million. He has 10 years of experience in investing, real estate, finance, and operations. Rohun, how you doing today, man?
I'm good, Willie. How are you?
I'm doing great, man. I appreciate you coming on the show. I'm excited to hear your story and how you got where you at today, man, because, everybody got a story and we're ready to hear it, man. So tell us a little bit about who you are.
Yeah, absolutely. I'm happy to share the story. So as you mentioned, my name is Rohun Jauhar. I'm the co-founder of JT Capital. We are a multifamily investment firm. So primarily what we do is we go acquire multifamily apartment complexes, manage them, and get extreme value out of them and create really great places for people to live. And so I love the business. It's very exciting. It's fast paced. I feel like my days just go by so quickly.
Yeah.
And then by the end of the day, I'm extremely exhausted. So that's a little bit about what we do.
Yeah.
And I'm happy to kind of share my background and how I got here if you'd like.
Yeah, man, because, a lot of people, make it to the top, but the ones that's listening to the show, man, there's some people that's trying to figure out how to do their first deal. So it's always great to hear the guest story on how they initially got their start. So, man, if you would just kind of take us back to how you, thought about real estate and how you, did your first opportunity.
Yeah, absolutely. So it starts actually back when I was a child. So I grew up in Michigan in a really small town called Rochester. It was about 1 hour outside of Detroit. And, I am the son of immigrants. Both of my parents came over here from India with virtually no money at all. My dad worked in engineering. My mom worked in IT. But my dad, he started doing, rental houses, single family homes. Yep. And so from like the young age of 5, I was traveling with him to Detroit. We would drive an hour, go look at houses, go check on residents, make sure things were okay, clean up things around the house and everything like that. And so I did that for years, just kind of like following my dad around doing all these things.
Right.
So, throughout my childhood, got that kind of like little real estate experience, didn't really know anything about the numbers, but my dad would teach me a lot about saving, investing, and all of those kinds of things. So, I went on to go to Michigan State, and go into finance there. I got an internship at GE between my junior and senior year, but I had this itch for kind of entrepreneurship and wanting to start my own company. But the thing was that, getting a job at GE, after my internship being offered full time for someone like me, who was just a small town kid from Michigan, thought you'd never really leave Michigan, was huge. So I went down that path, and it was fascinating. At GE, I got to pretty much travel the world through the programs that they kind of pulled me up and accelerated my career through. So I was able to travel to all these different international countries, live across the US and everything like that. Now, my last role at GE, I worked on the sale of one of the businesses. And through the sale of one of the businesses that we sold, it was a small business, roughly $200 million or so, which was small relative to the size of GE.
Right.
But the real value was in the real estate. And so through that experience, I was able to see the power of commercial real estate and just some of how the numbers worked, how the industry worked, and everything like that. And it also coincided because towards the end of my time there, I started getting this itch for entrepreneurship again. And starting my own company because I had spent a little bit of time at GE kind of going through the corporate route. Now, I decided to move out here to Silicon Valley and move to San Francisco.
Yeah.
I will always think about risk and de-risking things. So I went to go work at Facebook. Going from GE to Facebook, the average age of individuals at GE was, I think, 52 years old. At Facebook, It was 23. So the first time I got on campus, I told my wife, who was my girlfriend at the time, this is the Disney World for grownups. There are kids that are walking around this campus eating
Yeah.
ice cream. The only difference is they get paid for it.
Right. Right.
And so I went to go work at Facebook. I worked on the global real estate expansion for Facebook. We
Yeah.
were hiring 15,000 people and we needed a place for all of them to work.
Right.
So we opened up a lot of locations across the globe. And through that experience, I was able to learn, again, a lot more about the commercial side of real estate.
Yeah.
And just how the second and third order of effects work when a tech company, particularly Facebook, goes into a certain region. What does that do for property values? What does that do for jobs? What does that do for gentrification and all of those kinds of things?
Right.
Spent some time there, learned a lot. And then effectively, I realized I think I'm in a good position to start my own company. There will never be, more perfect time to do this than now. Why wait?
Yep.
So I just jumped into it, started my own company, decided to focus on investing in multifamily specifically because through my research and reading and talking to people, that to me seemed to be the most strongest, safest, and resilient asset class.
Yeah.
And so that's what I did through a combination of hard work, luck, things falling the right way. I was able to kind of build this portfolio. Now, the first deal, what I did specifically, in which I tell a lot of people who come to me and ask, how do I jump in? Go find people that have done this before and partner with them and figure out what is the value that you can add to them. And I kind of approached it as somewhat of a mini apprenticeship. On my first deal, I didn't care how much money I made. I just went into that deal saying, I'm going to say yes to every single thing that is asked of me, regardless if it's in my specific role or not. Right. And I'm going to do even more than that and ask, what are all the things that I can do to help? And by doing that, you just learn so much. And so I think for the first deal, it's really just about finding the right people, the people that you admire, the people that you can partner with, and not caring about the money, but rather caring about the learning and the value that you can provide to them.
Yeah. No, I mean, that's a pretty good story. So you didn't go the traditional route of buying like a duplex and then, quad 16 unit. You kind of you found somebody to partner with, and that's how you got into your first opportunity.
Yeah. So it's interesting. My first thought was, college towns are pretty resilient.
Yeah.
Now, my thought is college and education will be disrupted significantly, but I thought at least for the next 5 to 10 years, college will still be around.
Yeah.
So why don't I go to a place like Michigan State, buy up a bunch of single family houses, rent them out to college students? Most people have their parents co-signing, so it's pretty safe.
Yeah.
But I realize it's very tough to scale that. And if it takes, 60 days to close on a single family house for, 6 figures or something like that, that same amount of time and effort is being done on a much larger deal.
Right.
And so it took me a while to kind of get there, but I realized that just jumping into the big route is a much safer and better alternative because of economies of scale, margin of safety, and really what my goals were. And so I think it's a thing that a lot of people think of as, let me start small and then scale.
Yeah.
Because it's just how our minds work, thinking linearly, but no one ever thinks, I can just jump into the big one.
Right.
And that's kind of how I approached it. But I almost went the single family route.
Yeah. Now, I don't want to breeze past that, because that's very important what you just said there, man. So, for the people that's listening, what was the mindset, belief that you had, or what was the limiting belief? You said, going smaller seems safer, but what was it that kind of gave you that extra push to just go ahead and jump in and go big? Like, what was it that helped you, do that?
So for me, I think the big thing that separates people who ultimately end up being successful, starting their own businesses or starting their own company versus the people that don't, is primarily just action and fearlessness, right?
Yeah.
So I mentioned to you, I had been thinking about entrepreneurship when I graduated from college. I'd been thinking about it when I left GE, right? The only things that held me back at that time was primarily just fear, right? Of how am I going to pay my bills? What if this happens? What if this happens? If I fail, what will people think of me?
Right.
And ultimately, it took me a long time, right? Almost like it took me years to kind of get over that fear and really just like sit down and deeply think about it and think about like, I'm not assessing risk the right way here. The
Yeah.
worst situation in the world that could happen is, I have to go move back in with my parents, or I have to just go get another job, which is not a bad option at all.
Yeah.
And
Yeah.
so for me, it was kind of just like getting over that hurdle. My personal belief is that anybody can be extremely successful starting their own company. All it takes is just patience for a long enough time scale. And then you just need enough at bats. If you get enough at bats, ultimately you're going to hit one out of the park.
Yeah.
And it comes with all the hard work and the focus and extreme luck for sure. But
Yeah.
you need to do everything that's in your control and kind of just let everything else happen, because I believe that a lot of us have these fears that aren't actually rational.
Yeah. Yeah. And you said something really good there. Jeff Blunt, he has a book called Fanatical Prospecting. And he had a really good quote that stuck with me, man. He says that the more I prospect, the luckier I get. So, just kind of relating it to what you said, the more action you take, the luckier you're going to be with what you're trying to get done. So that's a really good point, man.
Yeah, exactly. Just get in the middle of things and, start taking action, and something will happen.
Yeah. Absolutely. So you're focusing on multifamily. You kind of got a little bit of taste of the office and industrial from the companies you were working with, but you decided to go with multifamily because it's safer in regards to people always need somewhere to stay. So we're both in agreement there. So, what are you doing right now? How are you going about finding your deals? Because, at the end of the day, you got to have deal flow to make deals happen. So where are you finding your opportunities?
Yeah, so primarily it's through, relationships that I've built with real estate brokers over time, right? We've done deals with them previously. And so, we get a stab at all of this deal flow that comes in. A lot of it is on market, right? So everyone has the equal opportunity to kind of the same deal flow, right?
Yeah.
It gets posted on their distribution lists and things like that. And then you just, if you're a first time or early on, you kind of just go through the process, and every touch point that you have with them, you're professional. But for me, it's primarily through that. And then the other piece is that, I'll try to develop relationships with owners or other people who are just in the specific markets that I look at that are looking at real estate, and I'll pay a finder's fee. For instance, if someone brings a 300 unit deal to me, let's say, I'll pay $100K finder's fee if we ultimately go after that deal.
Hold up. Let's just stop right there.
Right.
So I want the listeners to really hear that, because a lot of people, this could be a great way for them to, make some money. So number one, what markets are you focused on? And then number two, explain what that finder's fee, how that works, because, some people don't know what you mean there.
Yeah, absolutely. So the markets I'm specifically focused on are in Central Florida and then in Austin, Texas. Specific parts of Central Florida I really like. Melbourne, Florida in particular. I have a property there that does really well. It's along the Space Coast. Companies like SpaceX have been launching rockets there, which is fantastic. And then Blue Origin, Jeff Bezos, a space company as well. And really just like aerospace tech and high tech engineering jobs I really like there. Right. And then Austin, Texas, I really like. We can jump into the reasons why, but I believe right now that Austin, Texas has the ability and the opportunity to be the next San Francisco or the next New York. And I think there is great value to be found there right now. So those are the markets I like, and we can jump into why I like those. In terms of the sourcing of deals, so, a little bit earlier, we had talked about how if you're new, how you can add value to people, right? One of the greatest pieces of value that you can bring to people is great deals, right? Because that's something that is just, we're all fighting after the same deals. And if you can find a diamond in the rough or find an owner who wants to sell, that's huge. That's huge opportunity. And so the way that it kind of works is, if somebody brings me a deal that is, usually something off market, right? If it's on market, everybody's taking a look at it. I've probably already seen it, but something that they've said, I know the owner, he wants to sell, he or she wants to sell. Here you go. Here's the numbers, everything like that.
Right.
I take a look at it along with my partners, and then we just make sure that the numbers are going to work, go through the negotiation, everything like that. If
Yeah.
we ultimately end up closing on that deal, we will provide a payment to that person that found it. And, typically it can be cash, it can be something like equity, really
Yeah.
whatever they're looking for. Some people have just said, look, I'll bring you a deal, but I want to be operationally involved in this deal. I don't really care about the money. I want to learn a
Yeah.
lot about real estate. So I just want to
Right.
be involved in the actual management of this property.
Yeah.
Others just, want cash and those kinds of things.
Right. No, it's a really good way, man. Like you said, it's flexible where you can get cash or you can get, ownership of a deal that wouldn't have been possible by yourself. So
Right.
it's pretty incredible. It really is. So I mean, let's talk about, you found your opportunity, but for the individual that's trying to put a team together and do their first deal, because they got to talk to brokers. What do you see as their biggest challenge with getting the broker to believe that they can actually perform?
So yeah, the biggest thing is reputation and credibility, right? So if you don't have a track record specifically in real estate and you are going to be the main point of contact with the broker, you need to establish your reputation and credibility in a different way, right?
Right.
Explain to them the success that you've had in a previous industry or what you've been working on, right?
Yeah.
One. And then two, convey your credibility through the conversations that you have with them. Do all of the research that you can on your end. So when you go to that broker, you're on the same page and the same level with them in terms of talking about the market, knowing the numbers, knowing the terminology specific to real estate,
Yeah.
knowing those kinds of things helps establish credibility because the person on the other side of the phone understands, okay, this person knows what they're talking about, right?
Yeah.
And
Yeah.
through that, that's how you develop credibility and a reputation and get the broker to kind of trust you, right?
Right.
And then
Right.
you have to approach it as something that you're building a long-term relationship, not just a single transaction,
Yeah.
because that will be really important. Now, as you get into the deal, you're not going to be, it's not just going to be you as a person going after that deal, but there will be other people that may be competing with you, right?
Yep.
And some of those other people may already have a relationship with the broker. So in effect, you are not going to be the highest on the totem pole. So you're going to have to do
Yeah.
different things, right? It might be conceding on some types of negotiation terms with the seller, right?
Yep.
You are going to have to make some adjustments to make sure that you are able to get to that top there.
Yeah.
Sometimes it might be paying the higher price, right? But on your early deals, you're going to have to make some of these sacrifices.
Right.
The other approach should be, partnering with someone to say, as I mentioned earlier, you can be the main point of contact with the broker because you have the
Yeah.
reputation, the credibility. I'll do the underwriting. I'll
Right.
do whatever it may be to bring value. But in the event you do it, kind of yourself as being the main point of contact with the broker, I would focus a lot on that reputation and credibility and making sure that every touch point you have is very, very professional.
Yeah. No, I mean, I would agree on that. And like you said, even if you are trying to be the point person, if you're with a group, there's groups out there that basically help you get deals done. They'll sign on the loan with you and stuff like that.
Right.
Maybe you leverage that sponsor's experience to build that
Mm-hmm.
credibility with that particular broker. So that's just
Mm-hmm.
the one little piece that I would add to that. But that was well said. So I mean, let's talk about Austin, man. Austin's a really, really good market. From
Yeah.
what I've seen, I haven't looked at it too much, but I do know it's a great emerging market, and the price per door is high as heck. So, what do you guys like about the market? That's having you all in on it.
Yeah, so a few things, right? So one, I really, just based on my background and what I look at where are tech companies going? Where are the tech jobs going, right?
Yeah.
Austin has had 3x the national average for the last 5 years in terms of tech job growth, right?
Yeah.
So that to me is a great indicator of we have high paying jobs that are resilient and strong going into these markets. And
Yeah.
a lot of these people are millennials as well, right? Which
Right.
really helps because I understand how millennials think because I am one, and I'm able to kind of craft the management and the opportunities that we've provided our apartment complexes to
Yeah.
be able to cater to that demographic. Two is the cost of living, right? So you have this attractive cost of living in a state that has no state income tax.
Yeah.
And you have all of these people that are moving from San Francisco, New York City, Los Angeles
Yeah.
for the past decade, but now even more accelerated with this shift to remote work and a lot of the tech companies going remote for the foreseeable future.
Yeah.
Third, it's business and landlord friendly. Obviously, I mentioned the state income tax, but Texas in general has done a lot to provide opportunities for businesses to come there. It's
Yeah.
why Amazon, Facebook, Google have opened up offices not only in Austin but in all of Texas.
Right.
And it's also why Tesla has now opened a factory in Austin and is looking at opening another gigafactory in Austin.
Yep.
And then lastly, I touched a little bit about the shift to remote work, but I'm seeing it very, very clearly now. On my street here in San Francisco, there's at least one moving truck per day that
Wow.
I've seen for the past 2 months moving out here. And whenever I pass people on the street who I see loading their stuff into their moving
Yeah.
truck, I'll just ask hey, where are you guys going? And the number one place I'll hear is Austin. The second place I'll hear is Denver.
Wow.
And so I think you see a lot of these millennials that are primarily in tech that realize I don't need to live in a San Francisco, a New York City anymore because
Yeah.
my job is not dependent on the location that I'm in, right?
Right.
But rather I can move to these other lower cost of living cities that have all of the same benefits living in San Francisco or living
Yeah.
in New York.
Yeah.
And I think it's going to be a great opportunity for, a place like Austin, Texas, where right now, you're getting like 4 caps, let's say 4%
Yeah.
cap rate versus a San Francisco, maybe you're getting a 1.5% cap rate. Right.
Right.
And I
Right.
think that, as this trend continues, you're going to see those kinds of cap rates in the future in Austin.
Yeah.
And so that's why I think there's just great value to be found down there in Austin right now.
Gotcha. So let's talk about the ideal unit count you look for. Do you do only value add deals or do you do core plus deals? Like what kind of opportunities are you looking for?
Yeah, so our strategy is primarily to look at 150 unit to 400 unit apartment complexes, Class B specifically.
Mm-hmm.
Now, value add or core plus, I kind of group some of them in the same bucket. I primarily look for places where the downside is low and we don't need to employ a huge value add strategy in order to raise rents. So primarily we're looking at things where, the rents are lower than market, and it's usually due either to mismanagement, because I know we can easily fix that through just hard work and focus,
Yep.
or there's some types of light value add implementations we can do. When I say light value add, I mean things like, let's say, painting the exterior, renovating the clubhouse, converting a tennis court to kind of a social type area.
Yeah.
And then inside the units, just very simple things like smart home packages, Nest thermostats, USB ports, electronic keypads, things like that.
Yeah.
And then maybe some type of, painting of the cabinetry or installing granite countertops, those kinds of things, which
Right.
I can pretty much turn within, 4 to 5 days, if not less. And so that allows us to keep our turns very quick, and then it allows us to get residents in. And then the last thing we focus on is what are, along the lines of that management play, what are things that we can implement in this community, because we primarily target millennials and retirees in the community, to make it a better place for people to live here. So as I mentioned, for millennials who are working in tech and our engineers, we might host things like hackathons, right? Which I've never seen any other apartment complex doing. Usually like a Facebook will do it at their offices. But if we can do it at our apartment complexes where we're bringing engineers together from Facebook, Amazon, and Google, then it becomes more exciting. One, I think it's just great for innovation because we're helping people have a space to be able to create things. But then two, we're also building this community. And I truly believe that people don't just view an apartment unit as an apartment unit, but they want to view it as a home and a community that they're a part of. And we really try to help facilitate that.
Yeah, no, that's very important, man, having that sense of community, because that's what gets tenants to stay even when rents do go higher.
Right.
It feel like home to them. So, they're
Right.
not going to want to go anywhere else. So that's really good point you made there. And that's the first time I heard that as well. The hackathon, that's pretty
Yeah,
cool, man. It's pretty
I'm
cool.
giving away my secrets to all
Yeah,
the
man.
other apartment operators out there.
Yeah, for sure. All right, man. So, when you're underwriting your deal, let's say, somebody finds an opportunity, bring it to you. What are the red flags you look for to say, hey, this is not really an opportunity that makes sense for me?
Yeah. So the first thing I do whenever I see a deal is I can do a quick analysis within under a minute, right? So the way I do it is, and this is good advice, I think, for anyone who kind of, sees a lot of deals per day and is like,
Yeah.
how do I evaluate all these? Because underwriting takes a lot of time. So
Right.
I do a very quick analysis. I look at the purchase price. I look at the total income. I look at the expenses, the net operating income, and then I look at what is that cash on cash return and cap rate, right?
Yeah.
If I have a low cash on cash return that's not going to meet my criteria of, let's say, somewhere in the range of 6 to 7% cash on cash return,
Yeah.
I'm immediately going to throw away the deal and like just throw it in the throwaway pile and move on to the next one, right?
Right.
Now, you can do that in pretty much 30 seconds, right? All you need to look at is the trailing 12 T12 financial statement from the seller, and it'll show you those numbers.
Yep.
Now, let's say I have a deal that within that 30-second analysis, I say has that 7% cash on cash return. And people can find how to calculate these formulas online. It's pretty easy. But once you do that, then I say, okay, I have something that has passed the first level of, my criteria here.
Right.
Then I'll go open up that trailing 12 financial statement, and I'll just go down each line item to say, what is here that I believe is accurate?
Yeah.
1. 2, what is here that I believe I have opportunity on, either to probably reduce costs.
Yeah.
And then 3, what is here that is not complete? Oftentimes I will see trailing 12s or financials that do not have certain costs. And owners do this because they have a large portfolio, let's say, and some of their costs they may be holding at their corporate level and not putting on the property. But maybe I need to put that expense on the property. So just through repetition and experience, I kind of know where things are missing or where they may not be. And it's really just a digging exercise and asking why. So then I do that analysis, and then I go through, my model, and I'll put in, total rents, what I believe they are, or what they are today, what I believe I can get them to, total cost, what they are today, what I believe they will be. And then I do that analysis. I project it out for, 5 years, let's say. And then within it, I just do a scenario analysis. I try to be very conservative on one model. I create a baseline model, and then I create an aggressive model. Typically, for my investors, I want to bring them the most conservative because they're trusting me with their capital. And so I want to make sure that we are taking on enough margin of safety in these deals. We want to do no-brainer deals. We don't want a lot of risk. It's too stressful. So that's pretty much the process and how we go about it at a kind of a high level.
Gotcha. Now, did you guys create your own underwriting model, or is it like a standard one that you guys use, or what are you guys doing?
Yeah, I created my own, just based on my, experience, like I mentioned, working at GE in finance, then working at in Facebook and strategy and finance. I had a lot of experience in Excel and was spending so much time at GE and Excel. So I got pretty good with Excel and knew how to build the models and everything like that. I looked at, others to see how are people doing it within multifamily, how are people doing it within industrial, office, so on and so forth. And then I got a lot of ideas, and then I kind of just built mine from the ground up.
Right. Yeah. I mean, I had Rod Bridgely on a couple weeks ago, and he was talking about how he built his on, and he has one that, he lets everybody use, but he basically said, if you have the time, building your own model is going to work the best because you know how all the formulas work together in it. So.
Right. Yeah. I think, if you use other people's models, I think it's okay, but you really want to understand deeply, like spend hours, days going through to make sure you understand how one input in a specific cell in your Excel model affects everything else,
Right.
because it is truly important. And I remember seeing a study years ago that something like 90% of Excel models have errors in them. And these were the most sophisticated models that are used at
Wow.
like the Fed
Right.
and
Right.
on a macroeconomic basis. And so one error in a model can really screw things up. So
Yeah.
you really want to dig in and make sure you understand the models that you're using.
Absolutely. I would agree. All right. So last question here in this section, man. What is the biggest rookie mistake you see people making right now?
So I'll mention two actually. So one from a investor perspective, I think a lot of people focus on cap rate, and I
Yeah.
continue to hear this thing about the cap rates are too low. The cap rates are too low, and I truly believe that it's a wrong answer. I think that people need to look at cap rates in the context of what is the value or the return they're getting on every other investment class out there, as
Yeah.
well as what is happening in the broader macro and micro economy, right? Effectively, this year, what's occurred is unprecedented. The trillions of dollars that have been printed by the Federal Reserve have allowed, obviously, one, the stock market, but then all other financial assets to maintain their value, if not increase over this time.
Yeah.
And so you see this disconnection from the stock market, asset prices versus what is actually occurring, in our true economy. And so I think people need to understand cap rates in the context of everything that's going on.
Right.
And then you need to dig in at cap rates at a very micro level, right? Comparing a cap rate in San Francisco versus, Detroit, the risk reward is so much different. So it's just not even a apples to apples comparison. So that's one thing I would mention. The second thing is, I think from a general partner or kind of like apartment operator perspective, people get sometimes very aggressive with their numbers, thinking, oh, I can cut costs here. Oh, I can run this apartment better here and things like that. But you truly have to understand, once you actually get into the operations of a property, it's not just numbers on an Excel model or a spreadsheet. You're dealing with people day in and day out. And you truly have to understand the operations of the business. So just being very conservative and doing that type of scenario analysis in your models, I think, is extremely important.
Yeah. No, I mean, those are great tips. Great tips, man, for sure. All right, man. So let's go ahead and segue to the next segment of the show. We're gonna do a deal deep dive. So let's talk about a deal you've done recently. How many units was it? What was the value add play, the debt you put on it, and then the exit strategy for it?
Yeah, sounds great. So let's talk about one we did in that Melbourne area I was mentioning. So we found this deal in Melbourne through Cushman & Wakefield, one of the relationships that I had with a broker there. This was 200 units. It was bought as a portfolio from another company, kind of an institutional type company who managed a lot of properties. This property was actually built in 2001 by the owner of the Minnesota Vikings.
Oh, wow.
So that was pretty cool. Got to talk to him and everything like that. And it was just like a cool way, I think, to kind of like learn about the NFL and managing a professional sports organization. Now, he wasn't the buyer that we bought it from, but he was the original developer. So through a variety of connections, I was able to talk to him. But what bought this deal, 200 units, $35 million. And we put Fannie debt on it. We got a relatively attractive interest rate in the low threes. Right now, I think we're going to get a potentially even lower interest rate on another deal that we're pursuing because interest rates are pretty good right now. Let's see, 5-year interest only, 30-year. So, that was kind of the structure of the deal. Now, the business plan and the strategy here was, this is an apartment complex which is kind of surrounded in the area by a variety of Class A buildings, and this was Class B. And so when I looked at the rents at these Class A buildings, I was seeing rents as high as $1,700. Our average effective rent at this property was close to $900. And I said, we have a great opportunity here to be able to raise rents simply through, again, that light value add strategy, right?
Yeah.
But then also targeting people that are in that space coast who are cost conscious. And I knew that engineers are very, very intelligent, because they are the ones who truly, when they're looking at a place to buy, they'll do the Excel analysis. Oh, how much is it to cost? What's the cost to rent here versus here?
Right.
And then also, what is the amount of money that I can save here versus here?
Yeah.
People that are working at SpaceX, they're really focused on the equity that they have in their company. And so they really, really dive deep into those things. And so I knew that because of our unique advantages and strengths, that we would be able to specifically market to these people while still being able to raise rents, because the rent differential was so high. So our value add strategy there has been primarily to, again, do the interior unit renovations, things like granite countertops, stainless steel appliances, the smart home packages, one, and then two, do more of the community aspect. So things like the hackathons, the Taco Tuesdays. We do personal finance budgeting workshops. So we have a representative from a local bank come in and help people. For a lot of them, it's helping them think through what is the path to saving to buy a house, right? So we try to provide value in that way. The hold period on it, probably 5 years or so. And so far it's been doing good. I mean, it's spitting off cash flow more than we had projected, which is great. So investors are very happy. Throughout COVID, we made the decision to continue to make distributions to our investors, where I've seen a lot of apartment owners and operators stop distributions. So our investors were very happy about that. And that was a decision that took us a lot of time to think through. What are all the implications? What are all the risks? But that's worked out for us pretty well. So property's doing good. We hope for it to continue to do well, obviously. And our hold period on that will be, I believe, about 5 years.
Got you. Now, I imagine if it's in Melbourne, you probably there was a multiple offer situation, right?
Multiple offers. Yeah. So the way it worked is it was on market. Now I went to the broker and said, what would it take to take this deal before, everybody gets to it? How do we preempt everything and just kind of accelerate the process? And so the seller said, here's the number that we would be willing to kind of allow you to accelerate this process and not go through everything. And based on our, modeling, our underwriting and everything like that, we were able to hit that number. And, the beauty of kind of the units that we go after is it's not too small, but it's not too big. And so we compete with kind of, that lower market private equity or lower market institutional, let's say. For them, it takes a lot of time and meetings and bureaucracy to make decisions, where we can make decisions rather quickly because it's just a few of us. So we were able to preempt the whole process. We went through a buyer interview, and then, our PSA negotiations.
Hold up. Let's talk about that, because people don't know what you mean when you say buyer interview. So what is a buyer interview?
So the buyer interview is pretty much where you get on a phone call with the buyer and they ask you a variety of questions. So the way that the process works when you are going after a deal is, first you'll talk with the broker, get all the information, do everything you need to do on your end, right? Do the underwriting models, work with your loan broker to make sure that you can get debt on this property, right? Work with your insurance contact, say, hey, what are the insurance numbers going to look like on this property? What is the coverage that we need? You do that kind of like thorough initial analysis to make sure you're comfortable with going after the property, your numbers make sense. Then you submit a LOI, a letter of intent, which effectively states to the seller, here's the purchase price that we're willing to buy this property at. Here are the terms of the deal. Here is the timeline of which we would buy it, our due diligence period, those kinds of things. Once you do that, the seller primarily looks at, okay, what are all of these letter of intents that I have? Who do I feel comfortable going with based on input from the broker, as well as what the potential buyer is offering for terms, right? Then they usually whittle it down to a buyer interview. If you're going with a few people that were bidding on it, there might be 2 buyer interviews. In this process, we just had them interviewing us.
Right.
So the buyer interview, they go through a list of 20 questions, pretty much things like, what is your source of capital? Are you raising money? Is this from your family office? Do you own the capital?
Yeah.
Two, who else needs to make decisions on this? Have you toured the property? What is your due diligence process look like?
Yeah.
What is your current portfolio? Do you self-manage the property, or are you going to get a third-party property management company?
Yeah.
What does the debt look like on this? How have you modeled this, right? Because they want to make sure that you actually are being realistic. Otherwise, you might not close on the property. A variety of those questions to pretty much understand your credibility
Yeah.
and the amount of analysis that you've done on this deal. Because when they're selling a deal, they don't want to waste time. It's a
Right.
longer amount of time that goes through. They're potentially losing money, or things can happen on the market that may change the deal. And so it's a variety of those questions to make sure that you're actually a serious buyer. So, again, just like you talk with the brokers, you do this as well here, where you act very professionally, make sure you've thought through all of your answers and everything like that. And it's a good opportunity to get a sense of who the seller is as well.
Yeah.
After that, then, a couple days after that, pretty much they will award you the deal to say, hey, you've been selected. Then they propose PSA, purchase and sales agreement, where you typically negotiate within the course of 1 week or so, which pretty much is the legal contract by which you structure the terms of the deal for over the next 60 days.
Yeah. Yeah. Now on this particular deal, did you guys have to go hard day one on it?
Yeah, so we put 1% earnest money down. So we put $350,000 down. You do that. Every deal is different, right? But generally speaking, the way that I structure the deals is 1% earnest money within 3 days of signing that PSA.
Yeah.
That's non-refundable, right? So you're pretty much saying, hey, I got skin in the game here. I want to close this deal.
Right.
Then after that, we do 30 days of our due diligence period. We don't need 30 days, but we'll go walk 100% of the units. We'll do structural analysis, check the foundation, run cameras through the pipes, depending on the age of the property, all of those kinds of things. Do the lease inspection, make sure the leases match what we're seeing in the financials. Read all the vendor contracts, make sure there's no contracts out there that are unfavorable to us. Do all of that analysis. It really only takes us about 5 days. Maybe there's a few follow-ups after that take a week or so. We have that full 30 days. After the 30 days, then we put another 1% non-refundable or earnest money. So another $350,000 that we can't get back. And then we have 30 days after that to close. So about a 60-day closing process. We always try to close early. We try to make it very easy to work with us. We negotiate on things that matter, and the things that don't matter, we just set aside. And that's kind of how we go throughout the process.
Right. Now, this 1% that you're putting up hard 3 days after signing the PSA. So you've walked the property at this point. You have a pretty good idea of, the financials. So everything's kind of penciling there. And the only thing that would make you back out of the deal is during your actual due diligence period, something comes up that the seller's unwilling to, fix. At that point, would you just walk away and lose out on a 350, or do you have some kind of stipulations or loopholes in the LOI that says, hey, if I get in due diligence and I find this and you're not willing to fix it, then we get our money back?
Yeah, so the big exceptions are title and survey. So if we find something that's wrong with the title of the property or survey, we have the ability to get our money back, right? But outside of that, things like, if the lease inspection shows something like, the financials were way off, or we found a contract we really don't like, that's on us. And we kind of lose that money. Now we put our own personal money down, right, for the non-refundable. We don't use our investors' money. So we kind of take on that risk. But typically, I think for the size of assets that we're purchasing, one, and then two, typically the sellers, right? They're usually institutional. There's usually not a lot of, funny business going on. I would say usually they're pretty thorough, and things usually tick and tie. Now there may be little things, right? We do the 100% of the unit walks. We make sure we understand the condition of everything. such as, are all the sinks working in the units? Is there any mold? Things like that.
Yeah.
Are the blinds working? Everything pretty much in 100% of those unit walks. What is the condition of all of the air conditioning units, right? Now, if we go through every unit and we're totaling up to, $500,000 of deferred maintenance, because we say so many things need to be replaced, then we may come back to the seller and say, hey, can you work with us here? Like, we found, $500,000 of deferred maintenance. We want to, maybe like get that back in the actual, at the closing, right? They gave us $500,000. We never want to reduce the purchase price, because 70 to 80% of the purchase price is financed by a loan. So we don't do that, but we ask for that 500, and then we're able to go take that 500 for deferred maintenance. Typically it doesn't happen, because again, we've already toured the property. We've seen the condition. We bring our general contractor out there, see the condition of the roofs. We do that thorough analysis when we're walking the property to make sure we're comfortable with it before we're putting our own personal money down that we're potentially risking.
Right. No, that's all good points, man. You sound like you run a tight ship there, so that's the best way to be, man. Especially when you putting up your own hard-earned cash, man. You don't want to lose no money.
Right, exactly. We have systems, processes, checklists, everything like that.
Yeah.
And it really helps make sure we never miss anything, because things go by very, very quickly. It's fast paced.
Yeah.
I can easily forget things. So having a good system of, productivity, of action items, of tasks, and then checklists specifically to make sure you never miss anything in your process is extremely important.
Absolutely. All right, man. Let's go ahead and segue to the last segment of the show. So lightning round, 5 quick questions for you.
All right,
here we go. What's the best advice you ever been given?
Be fearless.
Love it. What is the best book you've ever read?
I love reading. Poor Charlie's Almanac. It's a collection of talks by Charlie Munger. And that book can change anyone's life, I think. I highly recommend that book. But I read so many books. I read multiple books a week. I love reading.
Gotcha. What are some rituals you've created that's making you a better investor or a person in general?
So a few things that have really worked for me is working out every morning. I need to get my workout before I have any meetings, check email, anything like that.
Yeah.
I think, prioritization is huge. If there's something that doesn't make sense to be doing, I don't do it. People can look up the Eisenhower matrix. It's a really good way to think about your work. Not drinking alcohol has been extremely impactful for me. Because I just have extreme mental clarity, and I'm just much more healthy and everything like that. And then I think just taking the time to kind of unwind, relax, make sure I'm spending time with family. I try to shut it off by like 7 p.m. every night. Usually on the weekends, I will work in the mornings up until like noon or something like that. But then on Saturdays and Sundays after 12 p.m. I shut it off and just spend time with, my wife and our family and friends. So those are a few of the things that have really, really helped me personally. And that is obviously transitioned into investing.
Yeah, absolutely.
And I'll mention one more thing, which is reading books. Reading books is one of the most impactful and highest return time activities you can do, leveraging your time.
Absolutely, man. All right. What is the one thing you're doing right now to help you improve your business?
I think the systems, as I mentioned, right? We're continually refining and updating our systems, processes, and checklists. And I think checklists within systems are the biggest things. So that to me is just being able to go to a specific note that we have in Evernote, right? That's shared between our team, pulling down the due diligence checklist, pulling down the checklist of things we need for our lender, those kinds of things, because that helps us see what is everything that we need to be doing and make sure we get ahead of it. So we're never focusing on anything at the last minute. We're always prepared for whatever needs to happen. And it allows us to be scalable on every single deal that we do.
Yeah, man, that's good there. All right, last question for you. If you can give your younger self one tip in regards to investing, what would that be?
Patience. I think the biggest thing is that people get impatient in investing. They want to chase returns.
Right.
But, I'm going to take this quote from Charlie Munger, who says the best investing is sit on your ass investing. You need to be patient. It's like baseball, right? You don't need to, it's better than baseball. You do not need to swing at every pitch. You can wait for the fat pitches and just hit those home runs.
Yeah. Man, that's good, man. You got to be patient, especially in this investing game. Good stuff. All right, man. Well, we're at the end of the show here. Tell my listeners, how can they get in touch with you?
Usually through email is the best. So my email is rohan@jtcapitalgroup.com. Rohan is spelled Rohun. I have a blog that you can find on my website, rohunjauhar.com. And then also I'm pretty active on Twitter. I love Twitter. It's one of the best places to be able to connect with people. I've made a lot of friendships there. And so you can find me on Twitter, which is just my first name and my last name.
Perfect, man. Appreciate you coming on the show today. You added a lot of value to the listeners, and I'm sure you can have some people reach out to you.
Yeah, thank you. This was awesome. Lots of fun. I appreciate you having me on, Will.
Absolutely.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.